Hi everyone. So this is the second part of my Unit 10 summary. This is the part that's going to look at banks and assets and liabilities and everything kind of around the financial sector. So the place where I'm going to begin is with this idea of a balance sheet, because balance sheet is a useful way of looking at two things. You can see here what the household or firm owns and what it owes. So when we use the term asset, what we mean by that is essentially all of the things that you own, right? And we're going to be careful in one sense, because the things that you own are obviously the things that you own, but also the things that other people owe you. So your assets are a combination of all the things that you own, as well as the things that people owe you. Whereas your liabilities, those are the things that you owe to other people, right? So if you have a debt, that is a liability because it's something you owe to other people. And so in a balance sheet, these are the two big categories: assets, the things that you own and that are owed to you, and liabilities, the things that you owe to other people. And we have a nice kind of identity, which tells us that assets are equal to liabilities plus net worth. And what we mean by net worth is just what we get from rearranging that identity, which is simply the difference between your assets and your liabilities. So that's what a balance sheet is designed to try and show us. Like at any point in time, what is an individual's net worth? What is the difference between their assets, the things they own and are owed, and liabilities, the things that they owe to other people? So this is something we're going to see kind of throughout the rest of this section. We're going to look at kind of household balance sheets and then a bank balance sheet in a little bit. Okay, so that's a balance sheet. And we jump straight into looking at how this can work for a household. And this is like one connection we're going to make with the previous section. So we're back with Julia again. And what we're thinking about with Julia is that same sort of situation she faced, where we know her income comes later on, and she's going to get $100 income, but she wants to consume now. And in order to do that, she's going to borrow. So we've got the now and the now before she's done any consumption. And what the balance sheet here is showing us is what happens when she takes a loan. And this is a really, really key point, that when a loan is extended to someone, that's going to actually appear on both sides of the balance sheet. So it appears on the asset side because by taking that loan, Julia now has $58 of cash in her bank account, say, that she can use. But on the flip side, she has a liability because she now owes $58 in the future to the bank that she borrowed the money from. And here we see the net worth coming in, the difference between assets and liabilities. And in this case, and this shouldn't be a surprise at this point, that the net worth now is actually just zero, right? Because taking a loan doesn't add to your net worth. And before any interest has accrued, it doesn't kind of take away from your net worth either. So now Julia decides to use that cash in her bank account to actually consume. And that's going to change things because now that cash is gone. It's gone to someone else, whoever she paid the money to get her consumption bundle. But that loan is still there on the liability side. And so now, after she spent that cash, her net worth has now gone negative, minus $58, because she owes that and she doesn't have the cash anymore. So then we jump forward to kind of the future. And in the future, this is where we know Julia is going to get her income, her endowment. And so we've got a couple of changes to her balance sheet. The first is on the asset side. She now has $100 in cash, right? That's the endowment, the income that's come in. And now something's happened on the loan side, on the liability side, I mean. Her loan has now jumped up to $64. Well, why? Because we're assuming that now some interest has accrued. And this is kind of approximations here, but we saw earlier on that Julia was maybe borrowing at a rate of 10% interest. So if she borrows $58, then over the course of whatever the borrowing period is, that's going to accrue 10%, which would be $5.80. And so approximately that's going to bring up the liability to 58 plus $5.80, so say plus $6, which brings it up to 64. So final stage is, well, actually, just before we get to the final stage, so what's her net worth now? Well, again, the difference between her assets, that $100 of endowment she's just got, minus her liability, the $64 she owes, so 58 the principal, and then approximately 6 in interest. And so she now has a net worth of $36. But now the final thing is she then consumes. And what we're looking at is we're assuming she is going to consume everything that's not required to pay back the loan. And so she consumes $36 out of the 100 she got, which means after that, she'll have $64 left in cash and a loan of $64. So she could use that cash to pay off the loan potentially, but that brings her back to a net worth of 0 again. So that just shows you how we can use balance sheets to sort of keep track of what's going on in terms of borrowing and spending. And I suppose the crucial thing that we've seen here, really crucial to keep in mind for later on, when a loan is extended, that's going to appear both on the asset side and the liability side. Okay, so now the next logical thing to kind of talk about is the institutions that quite often do the lending, which is banks. So what do we mean by a bank? Well, it's a firm. And like all of the firms, its goal is to maybe maximize its profits. And how does it do it? Well, it lends money, but it also borrows money from others. And the key thing that it wants to do is to have a different rate of interest on its borrowing and its lending. And I think we see it here. So the interest that the bank pays on its deposits. So when people come and put money into a bank account, normally there is interest available on whatever you put in. And the idea for the bank is to make that interest rate lower than the interest rate they charge when they loan out money to maybe other customers. And so the difference in the interest they have to pay on deposits versus the interest they charge on loans, that allows them to make a profit. So that's kind of just really simply what a commercial bank is trying to do. Okay, so now we know what a bank does. Now we're going to look at the different types of money, because this is going to help us understand a bank's balance sheet a little bit more clearly. So money can take form of banknotes, bank deposits, or whatever else one purchases things with, okay? 3 different groups or 3 different types of money. So the first is base money. So base money, cash held by households, firms, and banks, right? So actually like physical cash. But then one other thing, balances held by commercial banks in their accounts at the central bank. And these balances are called reserves. So the central bank is the one institution in a country that normally is allowed to create base money, to create actual physical cash. And so base money, it kind of accounts for that like physical cash that's been created and that households and firms and commercial banks hold. But it's also possible for commercial banks, they have an account with the central bank that will contain a certain amount of money, and the money that a commercial bank holds at the central bank is also part of this base money. And you can see here, base money is the liability of the central bank, as in the central bank are the ones that kind of are responsible for creating it, and they owe it to other people. Then we've also got bank money, and bank money is called bank money because it's money that commercial banks can create. So whenever a commercial bank extends credit, as in makes a loan, then it is kind of itself creating money. It's creating money to put into the account of the household of the firm who wants to borrow, but that money is bank money, right? So when it's put into the account, it's bank money. If the household of the firm wants to then come and withdraw that and spend it, then it would have to become base money, and then the commercial bank would have to provide that. But on that instant of creation of the money, of that loan being made, the bank is creating bank money. And then we have broad money, which I think is going to be less important for the rest of this like video. But broad money It's the amount of money that is in circulation. Right, and you can see down here, it's defined as the sum of bank money and base money that is in the hands of the non-bank public. So there might be bank money in the hands of firms and households, and that's in their accounts, right? And if they then go into a bank and withdraw it, it would have to become base money. And then there is obviously base money in the hands of households and firms. They might have some cash. And so broad money is the money that actually is in the hands of not central bank, not commercial banks, in the hands of the public, basically. So any money that's in the hands of the public, we refer to as broad money. Right. So I think next, we're just going to have a look at what happens if a bank decides to create a loan, extend some credit. So we have this like simple balance sheet to begin with, where Gino has $20 in terms of assets, as in, and actually, let me be clear here. We're looking at actually Bonus Bank, the bank's balance sheet. And so the bank has an asset of $20 because we're imagining that Gino has deposited $20 of cash into his bank account. And so the bank is kind of holding that. It therefore has this $20 as an asset. But there's also a liability on the bank from the bank's perspective, because at any point in time, Gino could come in and demand that. So the bank has an asset because it has this $20, but it's also a liability because Gino can come and just demand that $20 whenever. So now we imagine that Gino wants to get a loan, and he wants to get a loan of $100. And so Bonus Bank say, yeah, absolutely, that's fine. And here's where the bank money comes in. Because if we look at the asset side, right, the amount of base money is not changed when the loan is made. But now they're adding a $100 asset on in terms of a bank loan. And this is going to be bank money. And then on the liability side, we now see that they owe Gino the $20 from his deposit, but also this $100 loan. So you can see that this loan has been added to both sides of the bank's balance sheet, right? $100 in terms of an asset. Why an asset? Because the bank knows in the future, Gino is going to have to pay them back that $100, but also a liability because they are then putting $100 of bank money into Gino's account. And so he could at any point now come in and withdraw that and take it out. Now, one aspect we're not considering here is interest, right? Because once interest kicks in, once we get to the point where some interest has accrued on the loan, then that's going to change things. But this is just us looking at the kind of instant that the loan is made. And again, we see the crucial thing. The loan goes on both the asset side, because the bank is owed like a repayment, but also a liability side because Gino can come and now take out that $100 loan. So the bank kind of will owe that potentially. So to move on to the next bit, remember that this loan the bank created was bank money, right? It hasn't come from the central bank or like physical cash. The commercial bank has been allowed to just create this. So this kind of makes it seem like commercial banks can just sort of create money out of thin air, but that's not quite right. Because that money they've created, as you can see here, the money that banks create, it's a liability because Gino come in at any point and ask for that $100. And at that point, then the bank has to actually provide some base money, some physical cash. And so that's why it's a liability, because they could actually have to pay out that physical cash. And they don't have all of that physical cash, right? In terms of base money, they actually only have $20, based on this simple example. So where would they get the actual base money they need? Well, that's something we'll come back to in a little bit. But why do they want to do this? Well, because if we kind of fast forward and we imagine, so it says here, so if Bonus Bank lends that $100 to Gino at an interest rate of 10%, then it says next year the bank's liabilities will have fallen by $10. So, well, why? Because if Gino borrows $100 at an annual interest rate of 10%, we know that Gino is then going to have to pay the bank back, not only that $100 at some point, but every year, well, after the first year, an extra $10. And if that happens, then that is $10 sort of less that the bank will owe to Gino, because kind of Gino's given it to them. And so their liability falls. Now, their asset side, kind of, you can imagine the asset side that hasn't changed, but their liability, the amount that they owe to Gino, has kind of gone down by 10 because he has to pay them back $10. And this is where the bank can kind of then start to make a profit. That interest, right? Getting that interest back on the loan that it made, that's how it can start to actually accrue or like make a profit. And that's how it can start to increase its net worth, which we'll see precisely what that means in a little bit. So this is the key to where the profit comes from the bank. It's charging that interest on the loan. So let's talk a little bit more about, well, what else do banks do and the types of risks that they're taking. So one of the big services that a bank provides is what's called maturity transformation. And what we mean by that is essentially giving people the ability to plan. So when a bank takes in deposits, right, these are very, very short-term things, because at any point, the person who's put the deposit into the bank account could come and ask for it back. So the bank's in a sense in a bit of a tricky position. You can see it says it down here. The bank's engaged in sort of short-term borrowing, in the sense that the bank is kind of borrowing that money from the depositor, and it's short-term because the depositor could come back at any point and ask for it back. But what the bank kind of tries to do with that money is use it to help it fund some longer-term lending. So say giving out mortgages. Now, this is really helpful because a mortgage is the person who's getting it, because they know precisely when they have to pay back all of this money in the future. And that allows them to, as it says here, engage in long-term planning. And so we call this maturity transformation. Why maturity? Because the length of a loan is termed its maturity. So what the bank is doing is turning the short-term borrowing that it's doing, like these deposits that it has that are potentially there only for a short term, it's then actually using those to fund some long-term lending. But that process, although it's very good for the people doing the borrowing, and could be good for the bank because it's going to get interest payments back from this long-term lending that it's doing, it does open up potential risk. And one of those risks is called liquidity risk. And that's because the deposits of lenders, they are liquid, right? They're going to be, for the most part, in kind of base money, have to be able to be converted into, if they're not in base money, they have to be converted into base money very quickly, because depositors, if they ask for the money, they want the money now. Whereas when a bank, say, lends money in terms of a mortgage, right, it's not like the bank can then immediately ask the person who's got the mortgage to pay that money back straight away, right? It's over a very, very long time. And so we'd say that the deposits are liquid because they can be demanded straight away and can be turned into base money very quickly. Whereas something like a mortgage or a bit of lending that a bank's done, that's illiquid because it could take the bank quite a long time to kind of turn that money it's owed into actual money. And so this maturity transformation opens the bank up to what's called liquidity risk, like the danger that it might not be able to provide all of the liquid assets, say like the money that depositors are demanding. It might not be able to supply those straight away, and it might take a bit of time for it to actually turn some of its illiquid assets into liquid assets to provide what depositors are demanding. So that's a potential risk. And actually, if this turns into a big problem where actually lots and lots of depositors come into the bank at the same time and ask for their money at the same time, the bank is struggling to turn its illiquid assets into liquid assets. This could then turn into a bank run, where then the bank might end up actually going out of business because it's not able to provide all the money that the depositors are demanding. So that's what we mean by liquidity risk. Banks also face something called default risk, which is simply the people it's lent the money to, say, who have got mortgages from the bank. Well, what if they don't pay, right? And the bank is the one who's kind of taking the risk there, because then if no one's paying them back, then the bank just has this basically liability, has an asset that then is just kind of losing its value because no one is actually going to pay that asset back. And that's these two things, actually, liquidity risk, default risk. Those are two things that banks will take into account when they decide, how much money they want to loan out, because both of these things could end up, putting them out of business if they get to sort of a dangerous point. So I think now we're going to talk about what does a bank do if the demand for base money is beyond what it actually has. So we're going back to this bonus bank balance sheet where it's got $20 of base money, that's come from Gino originally. It's made a loan of $100 to Gino, and in terms of liabilities, Gino could come in and demand both of these things, the sum of those things, from the bank. And then we say, well, what if Gino comes in and wants to pay $50 to someone else, to Marco? From bonus bank's perspective, they're now a little bit nervous, a little bit worried, because they don't have $50, right? They only have $20 in base money. So what do? Well, a couple of options. One is they could go to the central bank and they could basically try and get the $30, borrow the $30 of base money from the central bank, or they could go to another commercial bank and borrow the money from another commercial bank. And the kind of combination of those two things is what we refer to as the money market. But borrowing from the bank comes at a price, and that price is the interest rate. But what interest rate do we mean? We mean the interest rate that the central bank has set. But what's going to determine that? Well, just like in lots of markets, the idea of supply and demand. So demand for base money and the total demand for base money is going to depend on, how many transactions commercial banks have, in the sense that, like, how many people across, say, a country are coming in and asking for base money on a given day. That's going to determine the total demand for base money, and the supply of base money, that's up to the central bank to determine how much are they going to actually be willing to give. So because the central bank controls that supply of base money, it can effectively control what the interest rate, what is the sort of price of borrowing. And so that's kind of how the central bank can intervene in this process. And we'll see how it can determine maybe how much borrowing is going on in the economy as a whole. But a really, really key thing is the central bank sets this interest rate, this base interest rate that we call I. But I also said that it's possible for a commercial bank not to borrow from the central bank, but actually to borrow from another commercial bank. And they will also borrow and lend to each other at that same interest rate. Well, why? Because if say a commercial bank tried to say, no, I'm going to charge you a higher interest rate, then you would just say, well, okay, I'll just go to the central bank then. And why it would make no sense to go for a lower interest rate, because then you're kind of losing out. And maybe you could do some speculation and try and make some extra money elsewhere, but typically the rate that commercial banks will lend to each other at is the same as the rate that the central bank is lending at, which is this policy rate, base rate called I. But a really key thing for banks then, commercial banks, is they are borrowing money at a rate I, the base rate, but they do not then lend out money at that same base rate. What they do is lend out money at a higher rate. And so you see the average interest rate charged by commercial banks to firms and households is the lending rate. And that will almost always be above the base rate or the policy interest rate. So that, again, banks are lending out money at a higher interest rate and they are borrowing money at, so that they can make a profit. So this diagram is quite useful for kind of putting all this together. And so let's start with the central bank. What do? Well, they are going to set the policy rate, the rate that money can be borrowed at. and that determines like the rate in the money market. And also, commercial banks can go to the central bank to kind of access reserves that they might have. And then looking at the money market, well, money market, commercial banks can also borrow money from that, as well as maybe getting reserves from the central bank. And some of the funds in the money market might actually be coming from savers, right? So savers, instead of maybe putting money into a deposit in a bank, maybe instead they're deciding that they want to maybe take more of a risk, and actually they lend money in the money market by buying government bonds. So they decide instead of actually just putting my money into a bank account with maybe a guaranteed rate of interest, I'm going to instead go and buy something a little bit riskier with maybe a higher rate of return potentially. And the money they use to do that then can go into this money market as well. And in terms of commercial banks, so in this like simple model, they are kind of getting some input from deposits from savers. They can also get some more from the money market as well. And then they are the ones, the commercial banks, that actually will lend some of this out to borrowers, obviously at a different rate than they are borrowing at, and also a different rate than they are promising to savers, a higher rate, so that they can actually make some profit out of this. So a really useful diagram for sort of putting all this together. Okay, so next thing we're going to look at is the balance sheet of a bank, just to understand kind of what's going on in a little bit more detail. So again, we've got like assets and liabilities. And right, so what we've got to be quite careful with here is on the asset side, it's kind of labeled nicely. This is stuff that the bank owns or that's owed to the bank. And from a bank's perspective, it's probably going to have quite a lot of stuff owed to it. And liabilities, what the bank owes to other groups, households, firms, other banks. So the first thing, cash reserve balances at the central bank. Okay, these are the bank's kind of own assets that it can go to the central bank and get those out. Then financial assets, so other financial assets, things that it might own. So it gives government bonds here. Maybe it owns some shares, some derivatives. So these are all kind of things it owns. Then we've got stuff owed to the bank. So loans to other banks, right? So this commercial bank represented in this balance sheet might have made some loans, might have let through the money market, other commercial banks borrow from it. And so that's money that's owed back to it. Then we can see a big chunk here, loans to households. So these will be, could be car loans, mortgages. This is a big chunk of a typical commercial bank's assets. So these are all amounts of money that households owe back to the bank. And then we've got fixed assets. So as in, these are kind of fixed assets, meaning like the bank's building, the bank's equipment, computers and things like that. So those also need to be incorporated into the balance sheet. And then that gives us the kind of total amount of assets. In terms of the liabilities, these are things that the bank owes to others. So deposits, right? So savers who have deposited money, the bank at any point will potentially, you could have to give those deposits back out. And so that is a liability to the bank. Secured borrowing. So this, and then we've also got unsecured borrowing. To kind of talk about both of them together, this is money that the bank owes to others. So that can include money that it owes to other banks or other financial kind of companies, right? And then just to talk about the difference between secured and unsecured. So secured borrowing is where maybe the bank has provided some collateral. So what that means is if the bank couldn't actually pay back the money that it owes, that instead the person it owes the money to or the other commercial bank it owes the money to could take some sort of asset. I mean, that could even be like government bonds. Whereas unsecured borrowing, they haven't provided any collateral for that. So this commercial bank has borrowed some money, but with nothing kind of backing it up. So that's the sort of asset and liability kind of side for a bank, and a couple more things to talk about. So at the very, very bottom, we see we've got this term net worth. So as we saw at the very start, the net worth of a household or a bank or any business is its total assets minus its total liabilities. So we just take the difference between the sum of the total asset, the sum of the assets, the sum of the liabilities, and we actually put this on the liability side, because we say that that net worth is actually owed to the owners, the shareholders of the bank. And that's why it goes on the liability side, because it's owed to them. And sometimes we can also call net worth of a bank the same thing as its equity. And then a couple more things. So insolvency. Well, we would say that a bank is solvent when it has positive net worth, right? So when total assets are greater than total liabilities. But a bank will become insolvent when the opposite is the case. If its total liabilities become greater than its total assets, as in the liabilities, the amount that it owes to other people, are greater than the assets, greater than what it owns and it is owed. At that point, we'd say that a bank has become insolvent, and then it's running the risk of actually going bankrupt. And one final thing, which is actually very, very important to be able to use and figure out from a balance sheet, is to look at the idea of a leverage ratio. So I'm going to run through a quick calculation with that, but just before I do, I'm going to take a quick pause. Okay, so just coming back to that. So as I was saying, like a really, really useful thing to be able to do is to, well, first calculate a leverage ratio, but then understand what that leverage ratio tells us. So for short, I'm going to write LR, and I'm actually going to, first of all, I'll write down the formula like in brief. So to calculate the leverage ratio, what we do is take the assets of the bank and divide by its net worth, which I'm going to write down as assets minus liabilities. So for the case of this bank here, that is going to be its assets, 100, divided by its net worth, which is 4. And so that will give us a leverage ratio of 25. Okay. Now, a good rule of thumb is that the higher the leverage ratio, the more at risk the bank is of going into insolvency. What I want to do is try and show why. And we're going to use these numbers here to try and give an example of that. So if I now know that the leverage ratio is this, well, what we're going to do is think about what would have to happen to the value of the assets to turn the bank insolvent. So I'm going to take basically this equation. I'm going to replace the LR, the leverage ratio of 25, and we know that's equal to assets over assets minus liabilities. And now I'm going to do a bit of rearranging, and I'm going to get that 25 times the assets minus 25 times the liabilities is equal to the assets, right? That's just me rearranging this. And then I bring this over here, bring that over here. I know at the moment that 24 times the assets is equal to 25 times the liabilities. And therefore that the assets right now are equal to 25 over 24 times the liabilities. Okay, now this is good. This all makes sense, because if we have a positive net worth, which we do, it's 4, then the assets should be greater than the liabilities. And what we're seeing now is that they are 25 over 24 times the liabilities. So what can be useful now is to think, well, what would have to happen to the assets to make it so that the assets and the liabilities are the same? And using this, we can see, and I'll do it up here, if the assets kind of fell in value so that they now were 24 over 25 of the original, we could see that that would make them then equal to the liabilities. And at that point, the bank would be on the verge of becoming insolvent, right? When assets are the same as liabilities. So 24 over 25, that is Okay, so that is 0.96, as in if the assets fell to 96% of the value that they were at before, then that tells us the bank would be on the verge of becoming insolvent. And so 96%, right? That is a fall in value of 4%. And that's the kind of link we get with the leverage ratio, right? Where's the link coming in? Well, if I do, pretty sure this is right, yeah. So if I do 1 over the leverage ratio, okay, so that's in this case equal to 1 over 25, that would be equal to 0.04, which as a percentage is 4%. So what the leverage ratio is telling us is what percentage fall in the value of the assets would get the bank to the point of insolvency, right? You can see, because what I've shown here is when the leverage ratio is 25, a fall to 96% of the original value of the assets would make them equal. But a quick way to get there is just to take the leverage ratio, 1 over the leverage ratio tells you exactly what the fall in the value of the assets would have to be in order to get you to the point of insolvency. So that's why just knowing the leverage ratio can be really quite useful. And maybe a final kind of key point on it is the larger the leverage ratio, the smaller that fall in value of assets has to be, right? So if I just take quickly, like another example, if I said, the leverage ratio is 36, well, if we do 1 over 36, then I believe, that will give us about 0.027. So this bigger leverage ratio shows us that an even smaller drop in the value of assets, here in this case, like 2.78%, would actually lead to the bank getting to the point of insolvency. So that's why leverage ratio can be quite a useful thing to look at. Kind of gives us a clear indication. If we just do 1 divided by it, gives us an indication of what fall in the value of assets would bring the bank to the point of insolvency. Okay. So a couple more things to now talk about. Just before I go into this, the link between interest rates and consumption, just going to take a quick pause. Okay, so just a final couple of things in this unit. So just the idea of this diagram is to show the kind of link between interest rates and consumption. So this is kind of relevant in terms of like policy terms, because it kind of is giving us some reasoning as to why the central bank changing their interest rate could actually have an impact on consumption right now. So we're going to make this justification is looking at the two situations that Julia faced earlier in the unit, where she's got 2 potential interest rates, right? The 78% interest rate, which gives a very, very steep feasible frontier, and then the 10% interest rate, which is shallower feasible frontier. And we see that her optimal choices at the 78% interest rate is at G, where she consumes 35 right now, whereas at the lower interest rate, because borrowing is kind of less expensive to her, she chooses the point E, where actually she consumes 58 right now. And so what does this show us? Well, if we translate these choices into a graph of interest rate versus consumption right now, and we see when interest rate was 78, consumption now is 35, but when it's 10, when borrowing is cheaper, she borrows more and consumes more right now, and consumption is 58. And what we can do is just kind of connect these 2 points up. And obviously we could maybe think about different feasible frontiers and finding different optimal points. But what we're kind of assuming is that this downward sloping curve here, this is sort of the demand curve that Julia has for loans, right? So at different interest rates, how much she's willing to borrow so that she can consume right now. And what does this show us? Lower interest rate, more consumption, right? And that's the kind of link we can make, and one that we'll see in future units, how interest rates and the monetary policy of the central bank can have an impact on consumption right now, and therefore kind of aggregate demand right now. But that's how we can kind of make a link between what's called the intertemporal choice that Julia has to make between consumption now and later on, and the interest rate decision of, say, central banks, which then lead or have feed into the interest rate decisions of commercial banks. Okay, so the second last thing is this idea that the kind of the lending decision of a bank or of anybody is another example of a principal agent problem. Why a principal agent problem? Well, if we think about a bank as the principal, the one who is lending the money out, and agent as the borrower, well, there's a bit of a mismatch in terms of knowledge. The borrower has a much better information about what they're going to use the money for. They have much better information about their ability to repay, and the principal, lacks some of this information. So what this diagram shows us is how the lender can kind of go about trying to align the interests of themselves and of the agent a little bit better. So step one, what does the lender do? They look at the characteristics of the borrower and the project. So they look at the wealth of the borrower. That's important because that gives them an indication of, how likely is this person to be able to pay the loan back, but also the quality of the project, right? The quality of the project, because the more, or if the project succeeds, much more likely to be able to pay back the loan than if it doesn't. Then the next thing, and this is a really, really crucial tool for the lender, is to see, well, how much is the borrower willing to actually kind of contribute to the project? How much equity are they willing to put in themselves? And this is useful for the bank because obviously the more equity that the agent, the borrower, is willing to put in, that gives the bank a bit of an indication about the quality of the project, right? If the borrower has a lot of belief in it and they're willing to put in quite a big share, that actually will make the lender, the bank, more likely than to say, yes, let's go ahead and do that loan. And on the basis of these things, lender kind of assesses the borrower's incentive, the borrower's incentives, like how strong an incentive do they have to work hard? If the project's maybe likely to succeed, maybe the borrower is going to work hard to try and make that happen. And then also, will the borrower has they picked a quite a high quality project? And again, this information about how much the borrower is willing to put in will give them an indication of these things. And on the basis of this, then the lender has to go and make a decision. But there's one element to this which raises kind of a bit of a problem, which is even if the borrower has chosen a really high quality project, what if they can't demonstrate that by saying they want to put in quite a large share because they just don't have a large share? What if they just don't have the wealth to actually be able to back up this investment? Well, what this then brings us to is how actually the possibility of not being able to access credit can have an impact in terms of inequality. So yeah, a few things here. So this idea that borrowers, people who genuinely need money, might be less able to access it. This kind of brings up this idea of credit rationing. So those who have less wealth, typically if they are going to borrow, get much less favorable terms, right? Either they don't get loans or they get loans at much higher interest rates. Or in some cases, we have people who are credit excluded, right? They just cannot get a loan at all. And people who can borrow but on unfavorable terms, we say are credit constrained. So this kind of raises a bit of a problem. And I mean, there are ways to potentially solve it, but the final thing we're going to look at is how this can then feed into potentially inequality. So we're going to take an example to then build some Lorentz curves. And so the example is this. We've got an economy that has 100 people in it, 90 farmers, and those farmers are borrowing, and they're borrowing from the other 10 people who are the lenders. And they're borrowing to finance planting and tending of crops. And okay, so we're told that when they sell the crops, this harvest, it's sold for an amount greater than the loan, which is good. And we're told that every euro that's borrowed and invested, the farmer gains an income of, so they get that €1 back, but then some profit capital pie on top. Okay, so this is the key thing, right? There's the profit that's been made on the basis of the loan. But the farmers then have to repay the loan, which they can do, right? Because they've got this one, like, so this one represents, the euro that they borrowed, but then that came back as some income. And so they can pay back the principal, but then there's also going to be some interest. And so they have to pay back interest at a rate I. So what we're now going to imagine is, or think about is, from the profit that's made, how much do the farmers actually get to keep and how much actually goes to those lenders? So we know that the kind of total profit that's made is pi. And then we know that the interest that has to be paid is I. So the borrowers, the farmers, they get to keep pi minus I. And obviously the lenders get I. So in terms of shares, right, there's a total amount of pi to be shared out. And I out of that pi goes to the lenders, right? So they are getting like I, that's their proportion of the profit. And in terms of the farmers, the ones who borrowed the money, what are they getting? Well, they're getting the profit minus the interest over the profit. That's their share. And we can actually simplify that as 1 minus I over pi. So this is a nice simple model, which shows us that the people who are lending, they're keeping I out of pi, so every bit of profit pi, they keep I out of it. And the farmers keep 1 minus I over pi. So now we put some numbers to this. So if the interest rate is 10%, the rate of profit is 15%, then what we're going to see is that you put those numbers in, that the lender's share of income, so that the lenders, the people who are lending out, kind of put these numbers in here for the lender. So I 0.10, pi 0.15. That means they get 2/3 of the income. And as a result, therefore, the borrowers get to keep 1/3. So what is this going to mean in terms of inequality? What we now need to do is plot some Lorentz curves, work out some Gini coefficients. Now, I won't go through all the calculations, but what we're going to look at is kind of what would be the impact of some of those borrowers being credit constrained. So I'm sorry, I'm just zooming out so we can see the whole diagram. So what we initially look at is a situation where all the farmers can borrow, right? So that's represented by this blue line here. So the 0th person to the 90th person, they're all the borrowers, they're the farmers. And as we saw, they get to keep 1/3 of the total income. So 1/3 of the 100% is going to them. That's that line there. And then those lenders, those final 10 people, they're keeping the remaining 2/3. And so just like with any other Lorentz curve, we could work out a Gini coefficient by working out, what's the proportion of the area in here divided by the area underneath the perfect equality line. And we see that gives us 0.57, right? I mean, you can work through that yourself. I won't work through the full calculation. The key thing here, though, is, well, what if we had some particular group out of these farmers who were excluded from borrowing, right? Who weren't able to actually go and borrow the money, bad credit history or something like that. So we imagine, what if these first 40 people were credit market excluded? And we assume, therefore, that they don't get to do the borrowing, they don't get to invest, and so their share of income is 0. So those first 40 people, nothing whatsoever. Then you've got 50 of the farmers who can borrow, and so they get to 1/3 of the total income that's raised. And then our 10 lenders, they get to keep the remaining 2/3. But what has this done? Well, now our kind of actual distribution, our actual Lorentz curve is that straight line there, that one up there, and then up here. And you can see that the area between the Lorentz curve and the line of perfect equality is now bigger by this amount, which what's that going to do when we actually go and calculate our Gini coefficient? It's going to push it up, right? The lack of access to the credit market for these people has raised the level of inequality, And again, if you go through the calculation, you can show that it raises it up to 0.70. So this actually shows us that like access to credit and the banking system can actually have like not having access can have a detrimental impact on the level of inequality in society as a whole. Okay, so that is it for the second part of Unit 10 on kind of banking and assets and liabilities. I hope that was helpful. Thank you for watching.